Welcome back to the Capital Breakdown. Today we're tackling a topic that might feel a bit counterintuitive: holding cash in a long-term portfolio. You've probably heard cash is trash, especially when markets are soaring. But is holding more cash really safer? Or is it quietly holding you back? We'll peel back the layers on cash, liquidity, and safety, showing why cash isn't just dead money, but how it can weigh on your growth if mismanaged. Along the way, we'll break down practical ways to think about cash allocation so you can manage your money with clarity and purpose. No hype, just grounded insight. Think of cash like oil in a car engine. You might not notice it when things run smoothly, but it keeps your portfolio's machine humming. Too little, and your engine overheats, meaning forced selling or missed opportunities. Too much, and you're hauling extra weight that slows you down. We'll find the sweet spot that keeps your financial engine running efficiently for the long haul. Stick around. By the end, you'll have a clear framework to treat cash not as a boring afterthought, but as an essential tool that helps you weather storms and seize chances without derailing growth. Let's dive in. First, what does cash really mean in investing? We're talking money that's easily accessible, like checking accounts, savings, or money market funds. It's the ultimate liquid asset, spendable immediately without selling stocks or bonds. This liquidity is gold when emergencies hit or opportunities pop up. Think of liquidity like carrying water on a hike. When you're thirsty, you don't want to hunt for a stream. You want water ready to drink. Similarly, liquidity means your money is ready without delay or loss. Cash is the lowest risk holding because it doesn't fluctuate like stocks or bonds. Stocks are roller coasters. Bonds rise and fall with interest rates. Cash just sits steady like a calm lake. The trade-off? It earns very little interest compared to long-term investments. So while stocks and bonds grow wealth, cash grows slowly, sometimes not enough to keep pace with inflation. Imagine parking money in a savings account earning 1% interest while inflation runs 3%. Your cash's purchasing power shrinks about 2% yearly. Cash is your safety net, stable and accessible, but also the slowest growing part of your portfolio. Understanding this trade-off is key to smart cash decisions. Why hold cash at all? Beyond emergencies, cash buffers market downturns. Imagine a storm hitting your portfolio. Cash means you don't have to sell stocks at a loss to pay bills. It's like carrying an umbrella on a rainy day. Not glamorous, but it keeps you dry. Cash also gives you dry powder to buy when prices dip. Say the market drops 15 to 20%. With cash on hand, you can buy quality stocks at lower prices, potentially boosting long-term returns. This flexibility is powerful during volatile markets. But here's the catch. Too much cash means missing market gains. If the market averages 7% returns and your cash earns 1%, you're leaving money on the table. Over decades, that difference compounds big time, and inflation slowly chips away at cash's purchasing power. Holding cash is like parking in a slow vehicle while others speed ahead. So, cash provides safety and flexibility, but it's not a growth engine. More like a shock absorber cushioning bumps but not accelerating you forward. Zooming out, a typical long-term portfolio mixes assets: stocks for growth, bonds for income and stability, and cash for liquidity and safety. The exact mix depends on your goals, time horizon, and risk tolerance. Younger investors with decades to invest might hold less cash because they can ride out volatility. Picture a 30-year-old with 35 years till retirement. They can afford a small cash buffer and stay mostly invested in growth assets. Someone nearing retirement might hold more cash for stability and immediate needs, like a 60-year-old planning to retire in 5 years. Balance is key. Too little cash can cause stress or forced selling during emergencies. For example, without cash, you might sell stocks at a low point, locking in losses. Too much cash slows growth, like carrying extra luggage on a long hike. Think of cash as your fuel tank. Empty risks running out in an emergency. Too full weighs you down. The right amount keeps you confidently on course. How much cash is enough? It depends on your situation. A common rule is 3 to 6 months living expenses in cash. This covers emergencies, job loss, medical bills, car repairs, without tapping investments. If your monthly expenses are $3,000, $9,000 to $18,000 in cash covers essentials stress-free. Some keep extra cash as a strategic reserve for opportunities. For example, if you expect a market pullback or plan to buy a home, holding extra cash makes sense. Imagine eyeing a home purchase in 12 months. Having a down payment in cash means you're ready. For long-term goals like retirement, excess cash might be better invested to maximize growth. Cash isn't a static number. It's a dynamic tool reflecting your financial landscape. Think of it like tuning your car's gas pedal. Sometimes you press for speed, investing. Sometimes ease off, holding cash. Your cash amount should shift with your journey's demands. A common mistake is letting cash pile up unintentionally. Maybe you sold stocks after a rally and are waiting for the right time to reinvest. But timing is tricky. Investors often wait for the perfect moment, which may never come. Cash on the sidelines erodes returns, especially in long bull markets. Another pitfall is holding cash in low-yield accounts that don't keep up with inflation. A savings account earning 0.5% with 2% inflation means your real purchasing power drops 1.5% yearly. So consider where you hold cash. High-yield savings or short-term CDs offer better returns while maintaining liquidity and safety. Some online banks offer savings rates near 4 to 5%, helping offset inflation. Make your cash work harder without sacrificing access. It's like parking your money in a garage that charges a small fee, inflation. But choosing a spot with shade and security. Higher yield, insured accounts, small gains add up. Liquidity and safety are the main reasons to hold cash. Liquidity means quick access without penalty or delay, crucial when emergencies or opportunities arise. Imagine needing a car fix immediately to get to work. Cash means no waiting days for withdrawal. Safety means your cash isn't subject to market swings, preserving your principal dollar for dollar. Unlike stocks or bonds, cash value doesn't fluctuate daily, but safe doesn't mean risk-free. Inflation risk silently erodes cash value over time. Also, cash outside insured accounts carries slight risk. Bank cash is usually FDIC insured up to $250,000 per depositor. Money market funds invest in short-term government securities and are generally safe but not FDIC insured. Ideally, keep cash in liquid, insured accounts or short-term government-backed securities. Think of parking your car in a guarded, easy-access garage, safe from theft or damage, ready when needed. Holding cash isn't without opportunity cost. Picture your portfolio as a garden. Stocks and bonds are plants growing. Cash is the soil. Healthy soil is essential, but too much bare soil means less growth. Cash preserves today's value, but doesn't plant future seeds. Over decades, markets historically outpace inflation, so cash above emergency funds acts like a weight holding back gains. Too much cash means idle money while others' investments grow. Still, cash reduces portfolio volatility, smoothing rough market rides. It's a balancing act. Enough cash to feel secure and nimble, but not so much you stunt growth. Think of cash like a house foundation. You need a solid base, but too much foundation and not enough building blocks means no rooms to live in. The goal, the right proportion to build a strong, comfortable financial home. Here's a practical example. With a $100,000 portfolio, holding 5% cash, $5,000, keeps a small safety buffer. You can cover expenses or seize market dips without panic selling. But if cash grows to 20%, $20,000, your portfolio feels safer, but misses growth from stocks or bonds on that portion. Over 20 years, that difference adds up. If stocks return 7% annually, $20,000 invested compounds to about $77,000 in 20 years. Cash at 1% grows to about $24,400. This shows why reassessing cash needs regularly matters. Too much cash is like parking in neutral on a highway, not moving forward even though the road's clear. What about market timing? Some keep extra cash waiting for a crash to buy at discount prices. Sounds smart, but perfect timing is very difficult. Missing just a few of the best market days can drastically cut returns. Studies show missing the 10 best days over 20 years can nearly halve returns. A more reliable approach is consistent investing, aligned with your horizon and risk tolerance. Holding some cash for opportunities is fine, but don't let it replace a disciplined plan. Think of cash as your emergency brake, not your accelerator. It protects, but doesn't time every twist perfectly. Staying invested steadily is like maintaining steady speed on a long drive. It gets you there with less stress. Cash in different accounts has pros and cons. Checking or savings accounts are ultra-liquid, but earn low interest, often under 1%. Great for day-to-day expenses, but not for large sums. Money market and short-term bond funds offer slightly higher yields with liquidity, but carry minimal risk. Money market funds invest in short-term debt, tend to be stable, but aren't FDIC insured. Certificates of deposit, CDs, lock cash for a set term but usually pay higher interest. A 6-month CD might pay 4%, while savings pay 1%. The trade-off: penalties for early withdrawal. Where you hold cash depends on your timeline. For immediate needs, keep it in insured, liquid accounts. For money you won't touch for months, consider higher yield options like CDs or money market funds. If locking money in CDs, align timing with your cash needs to avoid penalties. It's like choosing parking spots. Some are convenient, but pricey. Others cheaper, but require a longer walk. Diversify cash too. Though lumped together, you can manage it in buckets. For emergencies, keep some in your primary checking or savings for instant access. For short-term goals, vacations or home renovations within a year, high-yield savings or money market funds pay more interest and keep money accessible. For funds you won't need for a year or more, short-term CDs or government-backed securities earn more while staying safe. Treasury bills, backed by the U.S. government, offer security and predictable returns over short periods. This layered approach meets different cash needs efficiently. It's like a toolbox with different tools ready for different jobs. Each cash bucket balances liquidity, safety, and returns. This prevents scrambling when needs arise and helps your money work smarter. Before we wrap, remember, managing cash is personal. Your risk tolerance, life stage, income stability, and goals shape your best cash allocation. The Capital Breakdown encourages you to think critically, stay informed, and review your portfolio regularly. Use cash strategically as protection and power, not a default parking spot. And always remember, investing involves risk, including loss of principal. Do your own research and consider consulting a qualified financial professional for your unique situation. With the right balance, cash can be your portfolio's unsung hero, quietly supporting your financial journey over the long haul. It's the reliable foundation beneath your growth, the calm in market storms, and the fuel to seize chances. Mastering cash management means you're not just along for the ride, you're driving your financial future with control and confidence. Thanks for tuning in to the Capital Breakdown. See you next time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.